So
Yeah, more than that,
education.
hundreds of thousands to millions of dollars. I think it's interesting that it seems, and sometimes CPAs do it too, where they're just like, oh, just pay the tax. It's like, well, it's easy for the 1031 or the escrow company or the CPA. It's like, well, like this is 20, 30, 40, 50% of the proceeds. This is hundreds of thousands to millions of dollars of tax. To just be like, oh, just pay the tax. Well, maybe it's easier for you to say unless you're on the other side of things. Here's the reality. It's really interesting. People say, okay, let's take the worst case scenario. Like you go against the 1031s, I don't want to call it a recommendation because I'm not making tax advice or recommendations. They're just not going to cooperate. You go against the escrow company that is like, well, we're not sure. Okay, and you use our services, you defer your tax, okay? And again, in close to 30 years, never had a single negative effect. Lifetime audit defense provided by the tax attorneys, so there's no additional cost if you get audited. But let's just say you did, and it fails, right? It fails. What happens? Well, you would owe the tax, yeah, and maybe typically like a 10% penalty, okay? Now, and some interest charge on that. Hey, I'm Brett Swarts with Capital Gains Tax Solutions, and this is Susan Trujillo as well. Susan, how are we doing today?
I'm doing well, Brett.
So we're going to talk about what today, kind of tee it up, and then we'll just kind of work through one of the bigger objections for California deals, for escrow companies or real estate agents that are considering using the DST as a way to help their sellers exit. So what are we talking about today?
Right. So just industry standards. We have brokers who work with large 1031 exchange companies. They are reluctant to work on a transaction that has a deferred sale trust incorporated in their contract due to the fact that they have some worry that Franchise Tax Board or IRS might fine them for being involved in these transactions, which we know are legal.
Yeah, great question. So I think like anything, it's good to start with like the premise of any tax strategy, whether it be an IRA or 401k, or whether it be a deferred sales trust, whether it be a 1031 exchange. Like if you're not doing them properly, if anything, then they can fail and you can have taxes, right? Or if you're trying to do them a different way, that could be fine. Those are all really common things. And I think where the professionals get a little bit confused and or tend to maybe sometimes throw the baby out with the bathwater is when they saw the notice of the state of California. This is back in 2019, right? And it says, in fact, I'll just kind of share my screen and walk through this notice. So it says, subject, imposing the failure to withhold penalty against qualified intermediaries who actively participate in certain improper like-kind exchanges transactions, right? So the first thing to notice is they're speaking specifically to qualified intermediaries, right? So they're not speaking to escrow companies. Remember, a qualified intermediary is for a 1031 exchange, right? And so for an escrow company to say, hey, I'm pointing towards this as a reason why I'm not sure if the deferred sales trust or those that are like it are actually, there's something that we're doing nefarious or not doing properly or illegal or whatever, right? So to understand, like if you're basing it on that, this notice is only for that. It's not saying and escrow companies, right? So it's important to understand. Second thing to notice on this is it doesn't actually use the word deferred sales trust, right? DST, right. If you look at this, or deferred sales trust. Okay, so that's also the second thing. So they're making an implied, assumption that, oh, this must also include the deferred sales trust. And in fact, if you scroll all the way to the bottom, it talks about how the state of California recognizes the federal tax code, right? So no withholdings required, transfer certifies. Let's see where it says it here. To moreover, an immunity accommodator. And it's basically stating that these are the codes. So like 1031 exchange and IRC 453, these are not state level codes, right? They're federal tax codes, right? It's federal. And so this is not saying that you can't do federal tax deferred. Here it says right, California conforms to IRC section 453 pursuant to Revenue and Tax Code section 17551. right? So it actually is stating that, hey, if you're doing these properly, we agree with that. Okay, so what are they actually saying? Well, from what I've gathered from counsel and on this, they're basically stating that if you're not withholding to the state of California, while you're in an attempt to do a 1031 exchange and you're using an installment-like structure, and you're not withholding, then that's wrong, and you should be, and you're going to get fined, right? And by the way, we agree with them. You should withhold what's due to them, right? In fact, our strategies when we're doing it, we're always having and encouraging them clients, and I think all of them do. They all withhold, and so it's not an issue. Now, have there been copycats and those out there that have not withheld? And I'm sure there have been. That's probably why they're writing the notice. We don't know of them, right? But I'm sure there probably is. And so, again, just because the tax code is X and these are the rules, and people maybe don't follow those all the time, and there's a notice, it doesn't throw out that the tax code doesn't work now, right? And I think what's interesting is now it's close to 30 years, thousands of transactions, about 30 no change audits, with most of them being in California. We've never had a single negative result, okay? So to say, hey, this notice came out that doesn't mention the Deferred Sales Trust, and we're withholding, so I don't see it. And again, if you're escrow, what does it have to do with a qualified intermediary? So I think there's sometimes a bias that's built in. And by the way, I came from that bias. I grew up in real estate my whole life. I was at Marcus and Millichap, doing lots of transactions with you, Susan, when you're in Orange Coast Title, doing 1031 exchanges. That was kind of the beat of the drum that we would go to. It's only 1031, but realize there's a vested interest of keeping people just in 1031s and only beating to those drums. And some of these companies own the 1031 companies that are doing the escrow. Okay, so there's some conflict of interest there too, that if they can keep the flow of capital within their escrow company, within their 1031 company, within the next deal, and just keep it going around, they make more money. And so it's kind of like you follow the money. And so they want to, I think those sometimes either not see it and or just say, oh, I wouldn't do it, and by the way, they're not there to provide tax or legal advice, which is also the other kind of the funny thing here too. It's like these qualified intermediaries are not responsible for the taxpayer's tax dollar. We work with qualified intermediaries that are very open and happy to work with us. Other ones are like, no, we don't want to go there. Well, I think, is it because they don't want to have the business taken away? I think so, but it's up for them to decide. Susan, any thoughts or questions on that?
Well, my thoughts are, again, all the years working with you as an escrow officer, being compliant, knowing how the structure work is so important, and who in this industry that is handling the transaction legally is so important. So, again, working with our team here at Capital Gains Tax Solution is going to save you that worry and possible, doubt that's going to make you decide that maybe this isn't the right thing when, thousands of dollars could be lost. So
yeah, more than that, hundreds of thousands to millions of dollars. I think it's interesting that it seems, and sometimes CPAs do it too, where they're just like, oh, just pay the tax. It's like, well, it's easy for the 1031 or the escrow company or the CPA. It's like, well, this is 20, 30, 40, 50% of the proceeds. This is hundreds of thousands to millions of dollars of tax. To just be like, oh, just pay the tax. Well, maybe it's easier for you to say unless you're on the other side of things. Here's the reality. It's really interesting. People say, okay, let's take the worst case scenario. You go against the 1031s, I don't even call it a recommendation because I'm not making tax advice or recommendations. They're just not going to cooperate. Right. You go against the escrow company that is like, well, we're not sure. Okay, and you use our services, you defer your tax, okay? And again, in close to 30 years, never had a single negative effect. The lifetime audit defense provided by the tax attorneys, so there's no additional cost if you get audited. But let's just say you did, and it fails, right? It fails. What happens? Well, you would owe the tax, yeah, and maybe typically like a 10% penalty, okay? Now, and some interest charge on that. So you go, okay, and typically they're doing the audit in about year 2 or year 3, where they're doing the audit. So you've had at least 2 years typically to get some interest, and then in the audits in about, let's say year 2, year 3. If California is about 4 years, but most states are 2 to 3. Well, past that, if they don't do the audit, it's kind of like a statute of limitations. It passes unless you did something fraudulent, which you're not doing anything fraudulent, like you're just doing installment sale. In fact, the same installment sale reporting that you're reporting is the same form. I think it's 6252 is the same form you report the installment sale for the trust. It's the same one. Like so like what makes it think it's going to be a higher audit risk? We're also a very low audit risk. Okay, we've only had about 30 and thousands of transactions, and so again, you look at the evidence and you look at the fact pattern, and you go, why would you just say, oh no? But I think people get caught and they get scared because people or professionals say, oh, I don't know, and I've heard and this. And I think another big myth that's out there, Susan, is that the Deferred Sales Trust is on the dirty dozen list. This is what people say. It's on the dirty dozen list. And it's not. It's not. In fact, there's a blogger out there. I'll see if I can find his blog. And what he's referring to is the monetized installment sale.
Yeah.
Okay.
Yeah.
Dirty dozen. And it is on the dirty dozen. By the way, we've never done those. We've never recommended them, and we don't think they work. And for all these reasons that we can talk about here. But what's interesting is there have been, I think it was a QI company, and he's a very respected guy and practitioner. I'm not sure his name is, but he wrote basically, see, the Deferred Sales Trust is on the dirty dozen list. And you're like, and you actually go to the dirty dozen list, and it's not on the dirty dozen list. But the monetized installment sale is on the dirty dozen list. And this is a classic, throw the baby out with the bathwater to try to make a point. Like, okay, yes, the monetized installment sale claims to use IRC 453. They claim to use it properly within this installment sale structure. But what happens is they just give you 93.5% typically of the funds up front. They go, Susan, do whatever you want with it. Put it in your bank account, go spend it, whatever. And we'll call it a loan. It's kind of like a faux loan. It's a kind of a fake loan. And in about 30 years, we'll figure it out, and we'll get this bank to say that it has a loan. But you have all the money, and it's kind of like a sleight of hand for the way we see it. But you get constructive receipt, which is taxable all the time, right? Outside of maybe being a farmer, there's maybe, like, if you're actually legit a farmer, we think there's probably some legal precedents that you could use the monetize for that. But most people aren't farmers selling farms, okay? Right. So what happened was, it is on the dirty dozen list, but then the article people write is they say, like, these installment sale structures are all, and you're like, well, go to the dirty dozen list, look at it, and you'll see monetized installment sale. But what you won't see is Deferred Sales Trust. But what people do, or what people have done with these blogs, and remember, everything on the internet is true, right? What they do is they then take the blogs and they blast it out there. And it's like the drive-by media, people read it and go, oh my gosh, well, maybe I should be afraid of the Deferred Sales Trust. But if you just took 10 seconds and went to the dirty dozen list, you're going to see monetized installment sale. And you're not going to see Deferred Sales Trust. Don't you think the one that's the most popular it would say that? Well, no, because they have had the audits, they have gone through, and they have passed the audits with no change, no findings. So how could it possibly be on a dirty dozen list when it has that perfect legal track record? That is the question for those that are, opposed. Any thoughts on that, Susan?
Again, do your research and work with the right people, and you'll realize, those things don't.
Yeah. And by the way, people here's something I also learned from some. I've read some books and watched some podcasts. When people make like a really strong like statement, like, for example, I'm reading one from that has come up in the past, right? I'm just reading an email from someone that they'd sent in the past, and they say, the FTB has stated they are abusive tax structures and will fine any QI participant or referral source involved. Okay, this is this strong statement. The IRS has stated informally that they are abusive tax structures and do not work, but not release anything formally. Okay, so first of all, what do you mean by that? Abusive tax structures. Okay, what do you mean by that? How did you come to that conclusion? Where is that? Where is that information? Right? What are you talking about? Because the notice that we read has nothing. It says nothing to do with abusive. It says people aren't paying the withholdings, which is outside of the context of installment sale reporting, right? So we want to withhold. So when people make that, and oftentimes when you respond, hey, what do you mean by that? Where are you seeing this? Can you send me that? They either have nothing to send or they're taking it out of context. Okay. And
Right.
so you can err on the side of the person who's never done a deferred sales trust, who has a vested interest in keeping you in a 1031 exchange with their big corporate group that has a vested interest in keeping them within their escrow and then their companies that own the 1031 exchanges. Or you can say, you know what, I'm going to go with the guys that have a perfect track record, been through all the audits, and have never had a change, and actually are reading the documents in its context. You can decide, right? And if you want to side with this side and pay the tax, hey, we need really great Americans, Susan, to pay down that $40 trillion. Now, I hope it's not us. I hope that we get a chance to defer and build business. And actually, we actually do help pay it down, because we'll create more jobs and create more jobs, create more tax revenue. So it's actually why these strategies are in place. But again, if people make a very strong statements, it's not your job to try to refute them, although we're trying to refute some of these right now. It's really their job to provide the supporting documentation and arguments. I'll quick kind of end this with this last kind of thing. We had a gentleman on side of I think it was one of a Bigger Pockets blog, and he made these big statements again, and I was like, hey, wow, like thank you for sharing your opinion. Would you be open to coming on my podcast and just having a discussion about it, and we can just talk back and forth, right? Guess what? He didn't take the invite, right? It's like, well, why not, right? Let's go through it together. And yet they have these really strong opinions on these things, and they come out like with authority and like this is the fact, but they won't actually be open to having the discussion. So, but I encourage anyone who's listening to this that wants to come on and discuss and go back and forth with the pros and the cons and the potential risks. Happy to discuss. I'm not a CPA nor tax attorney. I just have studied and practiced working with the Deferred Sales Trust for over 10,000 hours and have some knowledge on it, but would be open to I think it's like change my mind, right, Susan?
Yeah.
Change. They said in the booths to say change my mind. Prove me wrong. I think that's the one they say. Prove me wrong. Any last questions or thoughts, Susan, or am I talking too much?
No, that's great, Brett. I think you answered it, and it's clear that our structure here is very legal.
Yeah, I'll do one more. Here's another one I was reading, right? Just because there hasn't been any issues on it yet, FTB or IRS could easily change their tune, okay? So you could say easily, okay, so what do you mean by easily change their tune? Like, you mean they're gonna go to the IRS tax code and change a 453 installment sale reporting that goes back over 100 years and then just like federally, in California, remember, it's not a California tax law, it's a federal law, right? So like, what do you mean by that? Like, what do you mean by change their tune? Like, where have they changed their tune? What makes you think that they're just going to easily change it? What do you mean by easily, right? It's like, and again, it's so easy for the person. It's like the Mike Tyson. Like, everyone has a plan until they get punched in the mouth, right? Punched in the nose and get in the ring with Mike Tyson. It's like everyone's, hey, on this side, when you're not having the millions of tax, when your exchange is not failing and you're not under the gun, I just think it's this. I think it's that. I think it's this. And just literally just like close their eyes to the lack of all of the deals that are closing. And again, it's not as if we don't have escrow companies, Susan, that are working with us, or 1031 accommodators that are working with us. We have those.
Right.
And they have no problem with it, and they've had no issues. So again, that's, you have to choose your team, right? And maybe you could say they're being more conservative, and that's what you want. Okay, at the cost of what? Your huge exchange failing, or just paying the tax? Every taxpayer has to have their own risk tolerance for what they think and choose their team. I just find the bigger the corporation, Susan, they tend to be they don't want to even perceive the risk. They're too big to even take on what they perceive as that could be risk, and so they're just kind of in a box, and they're like, we honestly don't really care. Like, we don't really care what you do or don't do. Because we have so much business, we can do whatever we want, and we can be close. It's like the classic, like, big corporation when you walk into a bank to try to get a loan, and they're just like, no, we don't do loans for that. And you're like, why not? I've been banking for you for like 20 years. I'm like, no, we just don't, or we stopped doing that. And you're like, but I have to go to like the private group or the credit union, and now they will, and they'll serve me better. Yeah. Because they get stuck in these big corporate boxes. Okay, we're way over time, Susan. I'm Brett Swarts. She's Susan Trulio. capitalgainstaxsolutions.com. If you want to learn more, I'd love the opportunity to sit down with you and your advisors to walk through if we could be a fit for you. And by the way, no worries if not. If it's not, totally okay. We don't owe us anything unless you close the deal. And for any reason you don't want to close the deal, you don't owe us anything. It's great. We like to compare and contrast all of the strategies so you can make the best decision. Susan, good talking with you. We'll talk soon, okay?